Do you want to invest in commercial real estate worth millions of dollars? Do you want access to the passive income systems the millionaires use? The answer is simple. Understand real estate syndication. If you meet the accredited investor requirements and the conditions of each deal, the door to entry opens. Why does it work? This slide explains it all. What is real estate syndication? It's a structure where multiple investors pool capital to co-purchase large properties that would be out of reach individually. A professional team called the sponsor handles everything: property selection, acquisition, management, and disposition. You put in the capital. Hands-on involvement is minimal. You'll still need to review documents and handle tax filings, but you're freed from day-to-day operations. What does the return structure look like? The target for annual distributions is 6 to 8%, and you stand to gain additional profit when the property sells. These are target figures, however. They fluctuate based on the interest rate environment and property conditions. Past performance does not guarantee future results. This is a strategy that only a select group of wealthy investors used to know. Today, I'm showing you exactly how this structure works and every risk that comes with it. Now let's get into the investment structure in detail. The minimum investment ranges from $25,000 to $100,000. It varies by project, but that's the barrier to entry. Start by understanding one critical premise. In a syndication, investors don't fund the entire purchase price of the property. Typically, 60 to 70% of the purchase price is covered by bank financing, debt, and the remaining 30 to 40% is covered by investor capital, equity. This is how leverage works. The return structure has two layers. The first layer is the annual distribution. Net income, rental revenue minus operating costs and debt service, is distributed to investors in proportion to their ownership stake. The target is 6 to 8% annually, but it fluctuates based on interest rates and vacancy. The second layer is the sale proceeds. After a hold period of 5 to 10 years, when the property sells, the appreciation in asset value is distributed to investors. Here's something you must always verify. Sponsor compensation is multi-layered. There are acquisition fees, asset management fees, disposition fees, and promote structures at sale, multiple fees at play. All of these come out of investor distributions. Always review the fee structure in the offering documents. Why do wealthy investors use syndications? There are 5 reasons. The first benefit: access to large-scale properties. We're talking apartment complexes worth tens of millions of dollars, completely out of reach for any individual investor. But through syndication, you can get in for $25,000. That said, asset class selection requires careful consideration. Right now, some office building sectors are seeing vacancy rates at record highs due to the entrenchment of remote work. Choosing the right property type, the right asset class, matters more than ever. The second benefit: professional management. Sponsors are real estate professionals. They handle property selection, financing negotiations, tenant management, and exit strategy. Your time is protected. The third benefit: diversification. Rather than owning a single property alone, you can spread capital across multiple properties and multiple markets. Risk goes down. The fourth benefit: minimal labor. You're freed from day-to-day operational tasks. However, reviewing documents, managing tax filings, and making decisions on capital calls when needed remain your responsibility as an investor. This isn't truly passive. Understand it as an investment with minimal labor, not zero labor. The fifth benefit: tax advantages. In the U.S., the building portion of a property can be depreciated. Residential rental properties over 27.5 years, commercial real estate over 39 years. Land is not eligible. Note that the bonus depreciation rules that once allowed large first-year deductions have been phasing out since 2023. 60% in 2024 and 40% in 2025. Tax law varies by country and individual situation. Always consult a tax professional. Let me be straight with you. Syndication carries risk. 4 of them. Anyone who invests without understanding these will regret it. The first risk: liquidity. Your invested capital is essentially locked in for 5 to 10 years. Early exit is difficult. Even if you can transfer your interest, there are restrictions, and fees or discounts will apply. Some deals have limited secondary market mechanisms, but don't expect the liquidity you'd get from stocks. Money you'll need next month. Money you'll need in 3 years. Don't put it here. Invest only with true surplus capital. That's the iron rule. The second risk, sponsor dependence. Your returns depend entirely on the sponsor's competence and integrity. A great sponsor builds wealth. An incompetent or dishonest sponsor generates losses. Investigate their track record, team background, and investment strategy thoroughly. Never skip due diligence. The third risk, accreditation requirements. In the U.S., the standard criteria for accredited investor status are net worth of $1 million or more, or annual income of $200,000 or more as an individual, or $300,000 combined with a spouse for the past 2 years. Furthermore, depending on the offering type, the issuer may require third-party documentation to verify your qualification. Even if you meet the accredited investor criteria, deal-specific acceptance conditions and regulations in your country of residence may still prevent participation. The fourth risk, interest rate and refinancing risk. This has become especially critical in recent years. In a sustained high interest rate environment, rising borrowing costs and deteriorating refinancing terms can lead to lower than projected distributions, capital calls, and delayed exit timelines. Don't take performance figures from the low-rate era and apply them directly to today. Now, let's understand the structure through numbers. Treat this as a conceptual illustration for educational purposes. Let's say the property purchase price is $2, $800,000. Investors don't fund the full amount. In a typical structure, debt financing covers 70% of the purchase price, $1, $960,000. Investor equity covers the remaining 30%, $840,000. That $840,000 is shared among multiple investors. If you enter at the $100,000 minimum, you hold roughly 12% of the total equity. Let's say the annual distribution target is 6%. 6% of the $840,000 equity pool is $50, $400. At your 12% stake, that's approximately $6,000 per year, about $30,000 over 5 years. Now assume the property sells after 5 years and sale proceeds are distributed to investors. An additional amount, proportional to your stake, gets added on top. This is where the metric called IRR becomes critical. Internal rate of return is the real annualized return figure that accounts for the time value of cash flows. It varies significantly based on distribution frequency, timing of the sale, and fees deducted. Whenever you see a figure like IRR of X%, always verify the assumptions behind it. This is an educational conceptual illustration. Actual returns vary based on market conditions, property performance, sponsor capability, and interest rate levels. Past performance does not guarantee future results. Some of you may be thinking, I don't meet the accredited investor requirements. That's an honest question. Here are 2 facts. First, options exist for those who don't meet accredited investor requirements. In the U.S., there are publicly accessible frameworks, Regulation A+ and Regulation Crowdfunding, open to general investors. These function somewhat like mini IPOs, and in some cases, accreditation is not required to participate. However, disclosure standards, investment caps, liquidity, and fee structures differ from private placements. Always confirm which regulatory framework a given offering operates under. Second, and this is the most important point, meeting the accredited investor threshold is a milestone, not the destination. A net worth of $1 million is achievable through disciplined, systematic wealth building. There's a critical caveat here. Meeting the accredited investor requirements is not a guarantee of entry. Deal-specific acceptance terms, KYC/AML screening, regulations in your country of residence, and minimum investment thresholds can all prevent participation. Understand that meeting the requirements is just the first step. You still need to clear the individual conditions of each deal. When the opportunity arrives and you're armed with knowledge, you'll be able to make that decision with conviction. Now let's lock in the key takeaways from today. First, real estate syndication is a structure where multiple investors contribute equity, combine it with debt financing, acquire large-scale real estate, and the sponsor manages all operations. The target annual distribution is 6 to 8%, with additional upside from the eventual sale. These are target figures. Actual distributions vary based on interest rate conditions, property performance, and the fee structure. Second, face the 4 risks directly. Low liquidity, sponsor dependence, accreditation requirements, and especially critical today, interest rate and refinancing risk. In a sustained high-rate environment, don't take historical performance figures at face value. Never enter without due diligence, without thorough front-end investigation. Third, there are 2 paths to entry. If you meet the accredited investor requirements, confirm the deal-specific conditions and consider entry using surplus capital only. If you don't meet the requirements, Reg A+ and similar alternatives, or simply continuing to build your asset base first, are the realistic path forward. Where are you right now? Do you meet the accredited investor requirements? Or are you at the stage where you need to accelerate your wealth building first? Share your strategy in the comments. Your current situation, your questions about syndication, your progress on the wealth building journey. All of it becomes the collective wisdom of this community. Thanks for investing your time with me today. On this channel, I break down investment strategies used by the wealthy, like real estate syndication, with the full blueprint, including the numbers and the risks. Financial freedom isn't a dream. It's a goal built on precise knowledge and calculation. If you want that conviction, subscribe and turn on notifications. See you in the next one.